Brad Neuman, passive investing has beaten active investing for almost a decade now. What makes you think this is going to change in 2015?
Yeah, it's been a very tough environment for active managers. In fact, last year, only 14% of U.S. large cap active managers managed to beat the S&P 500, and investors really been voting with their feet. This year, I think over $80 billion have flown out of U.S. actively managed funds, and over $40 billion have flown into the passively managed funds. But we think that the intense headwinds are actually going to reverse and turn into tailwinds going forward, really for four main reasons. One, rising interest rates. Two, improvement in international stock performance. Three, better small cap stock performance. And four, the maturation of the market cycle.
All right, let's start off with higher interest rates. How will higher interest rates help active managers beat ETFs and the indexes?
Yeah. So, in this very low interest rate environment that we've had, we think that investors have turned to equities for some of the attributes they've typically sought in bonds. So attributes like steady cash flows and high payouts. And that's created two problems for active managers. So when investors have been looking for these bond-like equities, they're like real estate investment trusts or utilities. Active managers generally underweight those groups, so that's been problem number one. Problem number two is, as folks have flocked to these bond-like equities, they've really done so at the expense of fundamentals, which has made it difficult for stock pickers.
All right, now let's talk about international stocks. Europe and Japan have outperformed U.S. indexes so far this year. And you say this is good for the actively managed funds.
Yeah, so it's good because U.S. indices don't hold international stocks, but domestic managers do hold some portion of their portfolio in international stocks, about 8% on average. And those stocks have really done poorly over the past several years, and it's created a headwind for active managers, about 50 basis points per year on average. But we think international stocks will do better going forward for two main reasons. One, weak international currencies and a strong U.S. dollar is good for international fundamentals, particularly exporters. And two, quantitative easing. Of course, Europe started quantitative easing in March of this year, and Japan continues. And we think that quantitative easing will be supportive of the supply-demand balance for risk assets going forward.
All right, now let's bring in the small versus large cap debate. So can you address that in terms of active and passive?
Yeah. So active managers tend to have a small cap tilt. They have smaller stocks on average than their large cap benchmarks. In fact, when we've looked at the data, there's almost about a 70% correlation between active manager outperformance and small cap performance relative to large caps. So clearly the two are linked. And we think small caps will do better for two main reasons. One, in a higher interest rate environment, small caps tend to do better. I think that's normally because interest rates are rising as the economy is doing better, and small caps have higher operating leverage, and so that would lead to better earnings growth from small caps. And two, small caps are more domestically oriented, and so with the weak international currencies we just talked about, investors may be more focused on small caps, which have less international exposure.
Finally, can you talk about the market cycle and where we are in that market cycle and how it frames the debate of active versus passive?
Yeah, it's a great question. So early on in a market cycle, macroeconomic factors tend to dominate and drive stock performance. So correlations are generally high and stock return dispersion's low, and it's challenging for active managers. But as the cycle ages and matures, idiosyncratic or stock-specific factors tend to drive returns, and it's much easier for stock pickers. In fact, if you look back at the last economic expansion in the second half of that cycle, 2005 to 2007, was when active management really came on and started outperforming the passive benchmarks.
All right, well, thanks a lot for coming on to talk about it.
Yeah, appreciate it. Thanks for having me.
And thank you for watching The Street.